the peace is already off and we're back at war. Gold continues to react to war news, escalation of war, as if it's bad news. But it didn't get below 4,000. So 4,000 is holding. Gold recouped a lot of its losses to close down just about $30 at $40.74. Silver also down on the day, but holding, close at $58.13, down $1.71. But it's not, wasn't down $4 or $5. So I think silver and gold are holding into support levels. And I think we're getting close to an inflection point where war news stops being bearish for gold and silver and starts being bullish, because it is bullish.
Gold and silver continue to react sharply to escalating geopolitical news, momentarily tumbling at the lows before staging a resilient recovery. While gold dipped significantly during intraday trading, it successfully defended crucial technical thresholds, signaling a deeply rooted structural support in the precious metals market amidst broader economic instability. Peter Schiff, a prominent financial commentator, global strategist, and outspoken proponent of sound money and gold, emphasizes that we are rapidly approaching a massive economic inflection point where persistent wartime news stops being a bearish trigger and instead turns aggressively bullish for gold and silver. He predicts that gold and silver will break through current support levels as investors realize the Federal Reserve cannot hike interest rates enough to outpace rising inflation, causing real interest rates to fall sharply. The broader markets are exhibiting major cracks as the Dow Jones suffers sharp drops, leaving only a handful of heavily concentrated tech giants to artificially prop up major indexes. This structural imbalance leaves traditional equities highly vulnerable to a deeper correction, while gold remains resilient above its major baseline. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
And now Donald Trump is saying, well, I don't even think I need a deal anymore. I can't make a deal, so I'm not really sure what the status is or what they're going to do. But the peace is already off, and we're back at war. Now, the markets reacted to this. The stock market was down. I think the lowest or the biggest drop I saw was maybe over 700 points in the Dow. I don't know if we were ever down 800 points. The NASDAQ was down, I think, a percent and a half, but the NASDAQ managed to finish the day positive. I think it was the only stock market index that ended up positive on the day. In fact, I think the reason that money is going into the NASDAQ is just a few tech stocks, the big AI hyperscalers. This is all that's working. It's the only trade that's actually still going, momentum trade. And so everybody is kind of piling in. It's almost as if the tech trade is the new safe haven. So the Dow is down over 1% today, about 570 points. Small caps were down about 1%. Gold was down. Gold continues to react to war news, escalation of war, as if it's bad news. And at one point, I think gold was down maybe 70 to 80 bucks at the lows, but it didn't get below 4,000. So 4,000 is holding. Gold recouped a lot of its losses to close down just about $30 at $40.74. Silver also down on the day, but holding, close at $58.13, down $1.71. But it's not, wasn't down $4 or $5. So I think silver and gold are holding into support levels. And I think we're getting close to an inflection point where war news stops being bearish for gold and silver and starts being bullish, because it is bullish. The Fed can't just talk about hiking rates. It's going to have to actually hike them. And if it doesn't, there goes what's left of the Fed's credibility. So the markets should be weaker. The stock markets should be a lot weaker right now with this threat, unless nobody believes it. But the gold traders believe it. I think that's the main reason that gold is still 4,000, 4,100. It's because of the expectation that the Fed is going to be hiking interest rates. That's why the dollar index is 101. The dollar rose based on the expectation that the Fed is going to be hiking interest rates. If it doesn't deliver these hikes, that amounts to a cut. In fact, it amounts to a big cut. Even if they do hike, it's a cut because they're not going to hike as much as inflation is rising. So real interest rates are going to fall. I've been hammering this point for months and months on this podcast. Investors don't seem to get it, but it doesn't matter what the Fed does on rates because even if we get 325 basis point rate hikes, that's 75 basis points. That's nothing. Inflation is going to be a lot higher than that, above what had been anticipated. And so real rates are going to go down, even if nominal rates go up. But the problem is we have so much debt, the economy, the labor market. I went over how bad the jobs numbers were that we got on Thursday on my last podcast. But the labor market is weak. The economy is weak. The housing market is weak. And the last thing that the markets could survive would be rate hikes. In fact, that's the main reason that the rate hikes were called off in the first place. That's the reason that when Powell was president, that they cut interest rates. It wasn't just to try to help reelect Biden or to elect Kamala Harris. It was because banks started to fail. It was because the economy was at risk because of the enormity of the amount of debt that we have. And our debt problem is getting worse.
The federal monetary policy is facing an absolute crisis of authority as institutional credibility hangs entirely by a thread. Recent central bank minutes reveal a staggering shift in sentiment, with an overwhelming majority of committee members suddenly reversing course to project multiple aggressive rate hikes before the end of the calendar year. This abrupt pivot exposes the inherent flaws in their data-dependent forecasting, especially since the underlying macroeconomic conditions have not fundamentally altered over the past quarter. The ongoing institutional attempts to project independence from political administrative pressures are largely theatrical, mask a deeper reluctance to confront systemic inflation, and represent a collective effort to buy time through bureaucratic delays rather than implementing necessary structural tightening. Now, let's get back to the interview.
So we got the release of the most recent FOMC, Federal Open Market Committee meetings. And look, the most significant aspect of this meeting, and this is the first meeting with Warsh as a Fed chair. And remember, Powell is still sitting in on this meeting. He's just no longer chairing it, but he's there. And so back in March, when Powell was still leading the committee, not a single FOMC member was expecting a rate hike this year. Right? They were still talking about rate cuts. Now, fast forward 90 days, and now nine of the FOMC members, I think there's 13 total, 9 of them see a rate hike this year. 9. That none of these 9 saw it 3 months ago. It's the same economy. I mean, how could things be so radically different that 3 months ago there was no sign of rate hike by these 9 guys, and now all of a sudden, we see rate hikes. The data didn't get that much worse. I mean, if you don't know what's going to happen or where rates should be, and then 3 months later you have a completely different opinion, this is all nonsense. This is all a charade. In fact, one guy who saw no rate hikes, I don't know if it was a guy or a gal, but one of the FOMC members who had no rate hikes now has 3 rate hikes between now and the end of the year. So he went from 0 rate hikes to 3 in the space of a meeting. Now, to me, this is probably all theatrics because now we have a new Fed chair who is trying to be hawkish, right? He's trying to pretend that he's hawkish by talking. And in fact, several of these FOMC members did indicate that they wanted a rate hike at the June meeting, but they decided not to. But they talked about it, or they thought that maybe it was appropriate, but they weren't in the majority. And so they, unanimously decided to wait. But I think that the FOMC under Walsh is now trying to deliberately create the impression that they're now got their inflation fighting chops and that they're independent, right, from the president, because the president has made it clear he wants lower interest rates. But the Fed is trying to maintain its independence, and at least they know that they can be independent now without incurring the immediate wrath of the president. Because in the past, the president was very vocal in his criticism of the Fed under Powell, specifically Powell, but also, Lisa Cook trying to, find a way to go after her. But I think the FOMC was concerned about that. They know that Walsh has a honeymoon, that there's going to be some time before Trump can actually come out and speak critical of Walsh, because he just spoke, so flatteringly how great this guy is, central casting, ordered him up, his standard line, but he just picked Walsh, right? He has a lot of confidence in him. And he said, hey, whatever he decides, he decides. So the Fed has a lot more room now to at least talk tough, to pretend to be tough, knowing that Trump is sidelined from speaking critical. So I think that that's what's going on here. I still don't believe that the FOMC actually intends to hike rates. These are the same guys that 3 months ago didn't think there'd be any rate hikes. Of course, 3 months ago, rate hikes were justified. They're still justified, but they were justified back then too. Inflation was much too high back then. It was obvious. And in fact, if you go and read the FOMC minutes, everybody was concerned that inflation is still too high. It's been too high for 5 years. So why did they cut rates in the first place, given where inflation was? Interestingly enough, though, even though everybody is concerned that inflation is too high, they all still think it's going to come back down to 2%. So they all still believe that their monetary policy is going to work. Even if it's taking longer than they thought, they still believe that ultimately, based on the policy we have now, that inflation is going to return to 2%. They just don't know when, but they have confidence that it will. But I don't know where that confidence is coming from. And in fact, they actually blamed inflation. If you look at the minutes, there were two kind of excuses for why inflation is high. One was the tariffs, right? So that's an excuse that they can keep on using, blaming on the tariffs, blaming on the tariffs. Yes, tariffs make some prices go up, but they don't make all prices go up. So tariffs are not the source of inflation. They are the source of some economic pain, and they can be the source of higher prices to the extent that they reduce the supply of goods. If there's fewer goods coming into the country, then they could all sell at higher prices. And that's not more money being created. That's fewer goods being supplied. So in that respect, but our imports have not slowed down. We're not importing less, and I'm going to get into that. We're still importing. We're just paying more for what we import and therefore running a bigger trade deficit. But the other excuse for inflation was AI. They're blaming AI for inflation, right? Because of the demand that AI is injecting into the economy, all of the resources that are being consumed to build out all the infrastructure, the data centers, putting upward pressure on prices. So even though in the long run, AI is supposed to be a force to lower prices by increasing productivity, in the short run, it is pushing prices up. But the real reason that prices go up is not because of demand for resources coming from AI. It's the Fed. It's the Fed's balance sheet that continues to expand. It's money supply that continues to expand. It's credit that continues to expand because the Fed is too loose. The Fed has interest rates too low now, and they've been too low for many, many years. And the Fed had an opportunity to try to correct that, and they punted. What did they do? Walsh set up 5 task forces to study the problems, which he had plenty of time to study these problems before he became Fed chair. Why he needs the task force and why the task force is going to be any better than the Fed. I mean, don't we have all these smart guys already studying this? Haven't they been studying inflation for years or decades? What's setting up a new task force going to do? Absolutely nothing but buy time. Allow Walsh to delay, to do nothing, while supposedly these task force are figuring out a solution to a problem that's obvious, but he can't acknowledge it because the politics of it are too bad. The problem is caused by too much government, too much government spending, too high deficits, and the solution is to reduce deficit spending, shrink the money supply, raise interest rates, but that's not politically viable because of what would happen to the stock market, what would happen to the real estate market, what would happen to the economy, so it's not going to happen. But I think that the markets, at least if they paid attention to what the Fed is bluffing here, if they're actually going to do it, because remember, what's left of the Fed's credibility is on the line here. Because at some point, the markets are going to expect the Fed to follow through. Because inflation is not going to come back down. Even though we had a pullback in oil prices, that's already reversing. But prices for everything are going up. That hasn't stopped. Those pressures continue to build in the economy.
The true underlying driver of persistent domestic inflation stems directly from the ongoing expansion of the central bank's balance sheet, escalating credit availability, and unsustainable government deficit spending. Rather than addressing these structural monetary expansions, institutional policymakers are deflecting blame toward external economic catalysts, including newly imposed trade tariffs and the immediate resource demands of rapid technological infrastructure buildouts. This refusal to implement aggressive monetary contraction guarantees that real interest rates will continue to decline significantly, even if nominal baseline rates experience minor upward adjustments. Consequently, traditional fiat-backed instruments face severe long-term purchasing power degradation, positioning physical precious metals as the ultimate structural safe haven against a systemic sovereign debt crisis. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.